Welcome to Financial Wellbeing with Emirates NBD, the podcast invested in your financial journey. I'm your host, Dana Kamber. If you've ever downloaded a stock trading app after seeing a stock trend or soar online, you've probably wondered, should I be trading or investing? And what's the difference between the two anyway? Joining me today to unpack and shed light on both worlds is Giorgio Borelli, Head of Asset Allocation at Emirates NBD. Thank you so much, Giorgio, for being here with us today on the podcast. I'm going to start off with the basics. What's the real difference between trading and investing?
So investing is getting consistent exposure to market risk. So you want to be in the market and for a prolonged period of time. In trading, you don't want that. In trading, you want to leverage short-term market swings. And since market swings are pretty unpredictable, you don't want to overstay your welcome, right? So you tend to stay in the market for as short a period as you can to get that outsized return as compared to the time you stay in the market, and then to get out, and that's it. So in investing, you aim for the long term, and why you want to have consistent exposure to the market and to market risk, because you want to get a return above cash. You want that, but you need to stay in the market for a sufficient long period of time. In trading, as I said, you want to leverage short-term returns. You're exposed to market volatility. It's totally a different game. You use different tools in one setting, and in the other setting, you have a different mindset. If you're an investor, you buy and hold. You're in the market for long. You will make fewer transactions. If you are a trader, you buy and sell frequently, and therein lies the issue, right? Because if you get in and out, you have to be good at trading back to back, meaning making gains. And that is extremely hard. So trading is not for everybody.
Yeah. You briefly mentioned mindsets. So what makes the mindset so different between a trader versus investor?
Yeah. Look, an investor must have a long-term goal, must have laid out a plan, must have patience and a long-term visions based on an investment plan, hence on what he studied about companies or securities or the macroeconomic outlook. A trader must be, on the other hand, nimble, decisive, reactive, a completely different psychological attitude, completely different skills, let's say. So traders and investors are a bit different, let's say different beasts.
Yeah, different beasts.
Yeah.
When looking at trading, a lot of people assume that trading gives you wealth faster. You make money faster with trading. Is there truth to that?
If you want to make money faster, you can in theory. And theory is always beautiful. And then when you try to implement, you fail. And when you lose money, you feel the pain, because losing money is one of the most painful things that you can go through. And so, as I said before, the issue for the trader is to get trades back to back right as many times as possible. Let's assume you have an 80% chance every time on making money on the market. It's very high. Traders never have an 80% chance of making money. So the probability of getting it right twice is 0.8 by 0.8 is 0.64. So less than 70%. But if you want to get it right 3 times in a row, probability falls to 50%. Mm-hmm. So you might wonder then, how do traders make money? It's simple. Well, it's not simple, it's hard. The rule is simple. The textbook rule is simple. So you make more money in each trade than when you lose. So if you gain twice as much as when you lose, then you can even have a 50% probability of being right. That's the knack, the secret. But to do that, you must have exceptional risk management skills and stick to that. And most traders are natural. The good traders are also natural traders. Mm-hmm. So they have an instinct and gut feelings that guide them. So again, it's not something for everybody. It's like navigating a storm. Not everybody survives the storm. So it's One can try, but
Building a little bit on risk, you mentioned that a little bit. Is one objectively safer than the other?
okay. Let's never say never, but anyway, if you invest, let's say, equity is the simplest example. Let's say you invest in equities, you buy an ETF, you get that exposure to the market we mentioned before. Assuming equities go up in the long run, which usually happens, although that's not always true. Suppose we are in a secular long-term bull market, so equities on average go up. So just by doing nothing and riding out volatility, you take one investment decision or very few investment decisions, and then you're fine because the market will do the job for you. If you're a trader, the market will be against you because, yes, you're smart enough to want to play shorter term swings, but those swings are up and down. So the market in that sense works against you. Volatility can work against you. So if you're not good at navigating that volatility, of course, you can lose money. So in that respect, yes, trading having shorter term time frame and noise being higher the shorter term time frames, then yes, you're on a higher risk.
From your perspective, what type of personalities gravitate more towards trading and what personalities gravitate more towards investing?
Okay, the investor have that kind of patience and consistency and doesn't mind, is not concerned with missing out on shorter term market movements. So I'm concerned more with the bigger picture, with a view that asset classes behave in a certain way, and so the investor has figured out how those asset classes behave or how a bunch of stocks behave, and so that's fine. Having exposure across time to that, it's fine for the person. So having the kind of vision and patience is key, of course, alongside the investment plan. On the other hand, a trader by nature, by disposition, it's more reactive and nimble, right? So different personality, the patience and visions versus the desire to engage day to day and being responsive. So it's different, very different personalities, I think.
Yes, not like, I think you have to have that shift of mindset if you're balancing both worlds, right?
Yes, you have to be a bit Dr. Jekyll and Mr. Hyde for that. Even in the novel, it was difficult at the time. So,
yeah.
So, yes.
We often hear when it comes to investing that it is 80% behavior and 20% strategy. From your experience, what are the common pitfalls people tend to fall into when investing and trading?
Yeah, so that's a good question because yes, the layman doesn't think about that. Doesn't think that behavior is so important, both in trading and in investing. For instance, when you invest, you can fall in the trap that you want to do what others do, and that's normal. We all human beings learn by seeing what others do from childhood. So why not do what others do in the market? So everybody talks about, let's invest there. Yeah. What about the old economy? No, that's backwards. If you invest in the old economy, you're old-fashioned. Well, that's not true. AI will be a good thing, but at some point it will be hurting, and telling when it's key. So at some point, every asset class gets crowded. Every bunch of stocks get crowded. So hoarding is not good. Holding on to losing positions, it's another thing that maybe an investor should not do either. It's true that you have to ride out volatility, but it's also true that sometimes destiny plays some nasty tricks. So if you hold on to a losing position at the top of you were holding to losing position at the top of the IT bubble in the year 2000, you might have gone through an 80% loss just because you think that holding for the long run is fine. Where the trader, on the other hand, can get into different pitfalls. Maybe over trading, looking at the screen too often, and then getting entangled in some sort of emotions around counter to being disciplined, around counter to the trader being able to manage stop losses, have stick with the risk framework, which is so important, as I mentioned before, for a trader.
Should a person's goal be the deciding factor whether to trade or invest? Like if someone is planning for retirement, should active trading be a viable option for them?
Well, yeah, I don't think so, unless one is a natural born trader. So if you're a natural born talent in something, you can do that something better than others. So if we get out of do away with that big exception, as I said before, trading implies being right so many times in a row that if you want to do that for the longer term, the number of trades you have to get right back to back is so big that you better let maybe the market do the right thing. Do its own work. As I said, since equities in the long run tend to go up, the usual plan is have some equities, diversify with some other asset classes, and then invest early enough so that for your retirement you have accumulate wealth enough. The big exception to this is that sometimes even equity markets go sideways for a prolonged period of time. And then even if you have exposure to the equity market, you don't tend to make much money. That's why there is alternative asset classes, but that's a different topic. So I'll just leave it there as a side remark.
Yeah, I think emotions play a big role in trading,
Yes.
as well as investing sometimes, right? And during
Yes.
volatility.
Yes.
What advice can you give during those moments when things go wrong for an investor or trader to continue that, positive outlook when it comes to their next move?
Okay. They should both know what they're doing. So it's as simple as that. They should have the plan, an investment plan or a trading plan. So the investor must have this investment plan for the longer term. The trader must have their own set of rules, technical rules to navigate the market swings. So the investor, for instance, in equities should know that equities tend to fall, have every year a 10% downswing. A few 10% downswings. The investor should know that during a recession, stocks tend to fall 30%. The investor should know that if they are unlucky, in the past, during crisis, stocks fell up to 50%. It doesn't mean you have to ride through all of that volatility. You must be ready for that in the sense that you must understand under which circumstances that happens. And that it might happen. And if you are good enough and identify those conditions, then you can somewhat diversify away from the riskiest asset classes, in this case from equities. For traders, they should know their stuff as well. So how to navigate, again, this market volatility. They must know what their skills are. Am I better at trading the market when it's very low? Trading the market is shorting the market when it's very high. Am I better at trend following and trading breakouts? What is the kind of volatility day to day that I sustain? How many trades per day can I take? Should I be a day trader or maybe a weekly trader? It's all different. There's so many different angles to it. So.
And from your experience, what helps you stay grounded when you have market volatility?
Okay, for an investor, it's about, technically, in terms of portfolio construction, is the fact that you are diversified. So you think that the losses are not going, hopefully, because the diversification are not going to impact your portfolio too harshly. Psychologically, you can stay grounded simply because you know how markets behave from experience. And so you have certain expectations. It's your experience that manages their expectation, then will tend to match reality. And so with that, you stay grounded. For the trader, it's a psychological game. So the trader must be good at navigating the storm of the market volatility. But sometimes it's really a storm. And so at those times, it's a matter of internal resilience and also the ability not to overstep the mark, meaning also that kind of risk framework that lets you know that you are safe even though, or you're not overexposed even though the market is in turmoil. I in that. But I mean, there is maybe traders who meditate, but that's a different kind of
Yes.
game. Because also being detached in certain times is important, while others would get overly involved emotionally.
Let's talk a little bit about trends and, hypes that we see on social media. And a lot of people might hear, now's the time to buy, or now's the time to start investing. How can you navigate those times and basically cut out those noises when the market gets really loud?
First, everybody should know that, they should be mindful that the prices let you know, the movement in prices lets you know what kind of psychology the market has. And then when prices tend to move a lot, you see investor psychology in action. So there is the prices plunge, there is panic, and prices skyrocket, there is euphoria. So it's always surprising to most people how much markets can overreact, how much euphoria they can be, overreact in both ways, how much euphoria there can be, how much panic there can be. And it's very difficult to assess that. So in investing, there is some gauges, valuations, when valuations are excessive. There is sentiment indicators, meaning surveys that are run regularly that tell us the degree of euphoria or panic in markets. So in general, it's tremendously hard, and the harder, and the shorter the time frame, the harder it is. But if you shorten the time frame, who knows what is happening in the next hour or tomorrow? You don't know, because a feature of the market is that the complexity that you see, the volatility that you see at longer time frames is replicated at shorter time frames, and even more. So you never get a time frame where you are less puzzled.
Yeah.
And that is a big issue.
I guess the key really is to continuously educate yourself with the updated and most recent research that you're looking at, right?
Yes.
And the information that you have available.
Yes. Or maybe not get overexposed to shorter time frames if you cannot manage those big question marks.
Yeah. So that's when trade or invest.
Yes.
Right?
Exactly.
And what advice can you give to someone who's thinking to do active trading for the first time?
Not overdo it, not being overly confident. Sometimes we think we can make assessments about an event. I know what I'm going to do in an earthquake. I know better than everybody else. Well, let's see. Wait for the earthquake, and we'll see. So the trader must really not be overly confident. He must maybe paper trade to have an idea of the kind of profit and loss, the dynamics of the profit and loss, and especially of the losses, how big they can be. So you should not only be focused on returns, but also potential losses. And then with paper trading, if the paper trading is somewhat of truthful semblance, then the person have a better gauge of how psychologically they're good at navigating the market.
And what's paper trading?
Paper trading means you don't trade your real money, so it's a bit it's a fake thing, but still it can help you have a feeling for what real trading is.
Oh, it's like practice, basically.
Yes, you don't commit money, but you start to say, okay, what would I be doing here? The trick is that being fake, you're not as psychologically involved, so the behavioral aspect doesn't kick in as much, but what to do? It's a tool.
It's an interesting tool to be available, actually. So you can test it out to see if it works for you or not.
Exactly. It's a tool, like, I don't know, performing dancing, not being on stage, but behind the scenes before going on stage.
What would be the key takeaways you want our listeners to leave with today?
Okay. For sure, the takeaway is that investors and traders should know what they're doing. They should study the markets. They should study the kind of beast they want to tame, because it's about that. Both they are subject to unexpected changes, because markets do change, And so they must be prepared to manage those changes. So focus on the risk that comes with a return. As I always say, investing in trading is trying to get a return above cash. But if you want that return, the market will punish you saying, okay, you must run a risk. Be aware of those risks, and there is a huge and steep learning curve for that, and then, well, be cognizant of that. That is the advice I would be giving.
Yes, I like that self-awareness.
Yes, self-awareness.
And for my last question, what's one financial belief that you had that's now changed?
I was thinking that if you follow a set of rules, you can be a good trader. Whereas I saw traders that were investing out of gut feeling. I thought that if you know more about markets, you can be a trader, a good trader. No, it's not true. Well, if you know more in general, let's say not more about markets. Well, it's not true because it's not about academia, it's about experience.
Mm-hmm.
So there are good traders that have a minimal amount of academic knowledge and yet are wonderful traders and make a lot of money. So that is also something I was not aware about, but I became aware of it as I watched the world around me, especially colleagues who could trade and could do things I was not able to do. And that's very fine because everybody has their set of skills. In terms of investing, maybe you realize that what you are told, markets always go up, don't worry, it's all fine. Well, it's not true either, right? Because times change, and yes, if you look at a few years of investing, it seems that nothing changes. What you learn in the books always holds true. But then, as your experience grows, there is always some factors you don't take into account. I started my career in a disinflationary period, and now I'm in an inflationary period. And investing is very different. So the belief that the factors that drive the market are always the same, for instance, it's also a belief I have to drop in investing.
Thank you so much for that. It was a great conversation overall on investing and trading. Thank you so much for your time, Giorgio.
Thank you very much, Dana.
To everyone tuning in, as Giorgio mentioned today, trading is basically about timing the market, while investing is about your time in the market. Until next time, remember, wealth doesn't build overnight. It's built with understanding, commitment, and patience.